Here's the strange thing about today. The market got some genuinely good news and sold off anyway. The Dow dropped 953 points, down 1.87%, to close at 49,919, back below 50,000. The S&P 500 fell 1.62%, about 120 points, to 7,267. And the Nasdaq lost 1.98%, roughly 509 points, to 25,170. All three finished near the lows of the day. The trigger was this morning's inflation report. Consumer prices rose 4.2% over the past year, the hottest reading in 3 years, up from 3.8% in April. On the surface, that's an ugly number, and the market treated it like one. But look underneath, and the story gets more interesting. Almost all of that jump came from energy. Gasoline was up more than 40% year over year, driven by the war with Iran and the disruption in the Strait of Hormuz. Strip energy out, and core prices rose just 0.2% on the month, actually cooler than economists expected, and slower than April. So the scary headline is mostly an oil shock bleeding through. The underlying trend isn't accelerating the way 4.2% makes it look. So why did stocks fall anyway? Because this was the first inflation report under new Fed Chair Kevin Warsh, who was brought in partly on the expectation he'd cut rates. A headline this hot makes that nearly impossible. Traders spent the day repricing, from betting on rate cuts this year to pricing in a real chance of a rate hike. Higher for longer came roaring back, and that's poison for the stocks that have led this market. You could see it most clearly in one name after the close. Oracle reported what should have been a triumphant quarter. Record revenue of $19.2 billion, cloud sales up 47%, earnings that beat, and raised guidance for next year. And the stock fell more than 7% anyway. The worry, Oracle is borrowing heavily to fund its AI build-out, and in a world where rates might be rising instead of falling, the market suddenly cares a lot more about that debt than about the record revenue. Same pattern as the index. Good news, sold regardless. Two things to watch from here. Tomorrow morning brings the wholesale version of today's report, producer prices, plus Adobe earnings after the close. And the deeper question both feed into, if today's inflation really is mostly an energy shock, it fades when oil does. But if the Iran disruption drags on, 4.2% might not be the peak. So here's the tension worth sitting with. 4.2% is a look in the rearview mirror. It tells you where inflation has been. Where it goes next depends on something nobody can price yet: how long this oil shock lasts. That's the number that actually matters, and it won't print on any calendar. We cover the markets on the days that actually matter, with explainers when it helps. Hit subscribe so you don't miss it. We'll see you next time.